The United States banking industry has seen its share of challenges and crises over the years, and March 10, 2013, was no exception. On that day, the U.S. government stepped in to shore up deposits at two failed institutions, including Silicon Valley Bank, the second largest bank failure in American history. The crisis had far-reaching implications for the banking industry and the wider economy, providing a number of key takeaways that are still relevant today. The first takeaway from this crisis is the importance of strong regulatory oversight of financial institutions. The failure of Silicon Valley Bank and the other institution was partially attributed to lax regulatory oversight. In response, regulators implemented stricter guidelines to monitor and regulate banks, and put in place more stringent stress tests to ensure that banks were better prepared to weather economic downturns. Another takeaway from this crisis is the importance of maintaining adequate levels of capital reserves. Silicon Valley Bank and the other failed institution were both highly leveraged, which left them vulnerable to sudden economic shocks. Banks that maintain higher levels of capital reserves are better able to absorb losses and weather economic downturns. In response to this crisis, regulators implemented stricter capital reserve requirements for banks, ensuring that they have the necessary resources to withstand economic volatility. The third takeaway from this crisis is the importance of transparency in the banking industry. One of the reasons why Silicon Valley Bank and the other institution failed was due to lack of transparency in their financial reporting. This made it difficult for regulators and investors to accurately assess the institution's financial health. In response, regulators implemented more stringent reporting requirements, ensuring that banks are required to provide accurate and timely financial information. The fourth takeaway from this crisis is the importance of maintaining a strong safety net for depositors. The U.S. government's swift response to the crisis helped ensure that depositors were protected, which prevented a wider panic in the banking industry. Ensuring that depositors have access to their funds during a crisis is essential for maintaining confidence in the banking system and preventing a broader economic crisis. In conclusion, the 2013 banking crisis highlighted the importance of strong regulatory oversight, adequate capital reserves, transparency, and a strong safety net for depositors. The lessons learned from this crisis have helped strengthen the banking industry and the wider economy, ensuring that the U.S. financial system is better prepared to weather economic shocks. While no system is completely immune to crises, implementing these key takeaways can help minimize the impact of future crises on the banking industry and the broader economy. Press like and thanks for tuning into the AM Block Report.